Good afternoon, and thank you for joining us for Ethanol Producer Magazine's webinar on tax reform, how changes will lend fresh opportunities for ethanol plants. Today's webinar is sponsored by Keiko Isom, a very different consulting and CPA firm. My name is Ron Cutterba. I'm a biofuels editor with BBI International, and we're happy to have you with us this afternoon. A major accomplishment by the Trump administration in its first year was leading and getting Congress to agree on a major overhaul on our tax code. This was no small feat, as it was the first major tax reform package the U.S. government passed in more than 30 years. The changes are far-reaching, and it's no understatement to say that this affects every tax-paying citizen and every kind of business in the country. Some changes provide financial opportunities, while others may add new liabilities. This is where prudent planning with experts like those at Keiko Isom, and we have 3 of them with us here today, can pay dividends for your ethanol plant and its shareholders. A quick note before we begin with the presentations. If you have a question for our speakers, please type it into the panel on the right side of your screen during or after their presentations. After our speakers have presented, I will be reading the questions to our panelists, and we hope to get to as many of them as possible during our Q&A session after all the presentations. If your inquiry is for a specific speaker, please indicate that in your question. Also, please try to use complete sentences and avoid abbreviations or acronyms, as we will be reading these live during our broadcast. Before we begin, let us pause for a brief word from our sponsor.
Keiko Isom is a national accounting and financial consulting firm that specializes in food and agriculture. Our biofuels experts have deep knowledge in day-to-day financials of ethanol plants, and we work with many biofuels producers across the country. That's why Keiko Isom wants to make sure you don't leave money on the table in light of tax reform. The recent Tax Cuts and Jobs Act signals the most dramatic change in over 30 years of tax law. There are going to be winners and losers, but if you start analyzing the impact on your business now, you can create opportunities. No business will be untouched by this new legislation. Ethanol plants will be impacted. You need to be out in front of these changes and make adjustments where necessary. Keiko Isom Biofuels tax experts have reviewed and researched the new tax provisions, and we know how these tax provisions will impact ethanol producers. Go to www.keiko.com to learn about our tax reform assessments. Don't leave money on the table this year.
All right, let's get started. I'm pleased to welcome our 3 guests. We have Brian Keel, Donna Funk, and Justin Mentley, who I'm going to introduce right now. Brian Keel is a principal and director of federal affairs at Keiko Isom. During the past 20 years, Brian founded an environmental consulting firm and served as acting chief of staff, legislative director, and environment and energy advisor to U.S. Senator Max Baucus. A leader in sustainability, he was awarded the Loeb Fellowship at the Harvard University Graduate School of Design and selected as a U.S.-Japan Leadership Program Fellow. Donna Funk is a certified public accountant and principal with Keiko Isom. Donna leads Keiko Isom's biofuels practice area, specializing in succession planning, multi-state taxation, inventory management, finance, and traditional tax, audit, and accounting services. Donna connects with manufacturing and biofuels business owners through her vast understanding of these unique industries, including impacts like commodity pricing and fluctuating economic challenges. And finally, today we have Justin Mentley, a certified public accountant with Keiko Isom. Justin works with closely held manufacturers and biofuels companies in all facets of their business, from tax and audit to compliance and entity structuring. Justin says he likes being a part of a team of consultants that turns customers' dilemmas into opportunities for greater success. His primary objective is to build relationships with customers, helping them mitigate liabilities and create valuable results, always remembering the impact on the businesses and the families that own them. Brian is going to get things started, and then he's going to pass it over to Donna and then to Justin, who will back cleanup. we're keeping things rather fluid as our presentations may be somewhat conversational in nature. So we're going to go with the flow as we learn what these experts from Keiko ISOM have to share with us. And finally, remember, if you have a question, send it to us through the panel on the right side of your screen, and we'll get to them during the latter portion of our broadcast. Okay, thank you, Brian, Donna, and Justin for joining us today, and welcome to the broadcast. Brian, why don't you take it over from here?
Perfect, Ron. Well, thank you so much, and thank you to everyone that's online today. Looks like we have a great crowd of people from all across the country, and it's heartening to see so many people dialing into this webinar. As Ron mentioned, my name is Brian Keel. I'm Director of Federal Affairs for Keiko ISOM, and in that role, I play a couple of roles within Keiko ISOM. Number one, I direct our lobbying activities. So to the extent that a client needs assistance lobbying on a change to the tax code or on the farm bill, we have a team of lobbyists. We have an office in Washington, D.C., and we engage on behalf of our clients to adjust the tax code or to adjust regulations in a way that are necessary and beneficial for our clients. That sets us apart a little bit from most other accounting firms in the United States, I would say, and for that matter, consulting firms. I'd say that if you looked at the biggest firms in the U.S., the top 3 accounting firms, they have D.C. offices, but outside of that, very few do. And the reason Keiko ISOM has a lobbying practice and a D.C. office is really it's based on our belief that some of our core principles are, number one, we are embedded in food and ag. We're part of the food and ag community. Number two, we want to demonstrate thought leadership and leadership within the community to help advance the interests of our clients. And number three, unlike a lot of firms, we don't want to be reactive. We always want to be proactive. So I think there are a lot of firms out there that will give a briefing on how the tax code changed and say, unfortunately for you, it's worse, or good for you, it's better. We wanted to really position ourselves to be a firm that proactively tries to set the table in a way that benefits our clients. And so that's what we've tried to do, both in the context of tax reform, and as I mentioned, we're gearing up on the farm bill, and then other individual pieces of legislation that move that are not maybe the big headline grabbers. We're doing similar things, I would mention, on international trade increasingly as a firm. So let me give you a little bit of a background to how we participated in the tax reform discussion. I think that'll set the table for Donna and Justin's presentations. So our work on tax reform really started back in 2013, so going back 5 years now. In 2013, there were tax reform proposals put forward in the House of Representatives by then Chairman of the Ways and Means Committee, Dave Camp, and he proposed a dramatic restructuring of the federal tax code. We took a look at those proposals, and were very concerned specifically about a provision that would have limited the ability of ag businesses to use the cash method of accounting. So one of the things Keiko ISOM did is we started an ad hoc group called Farmers for Tax Fairness. And Farmers for Tax Fairness was focused on raising awareness about how important cash accounting is to ag businesses. Farmers for Tax Fairness, we ran a coordinated campaign over a number of years using contributions from ag businesses and clients. And we were actually able to get that provision stripped out in Chairman Camp's subsequent bill drafts. When he introduced a bill, it actually exempted farm businesses from the cash accounting changes. So we were very pleased with that victory. That really set the tenor, I think, for tax reform that happened in 2017. One of the notable things in that tax reform package was that no one touched cash accounting. In fact, if anything, they made it a little bit easier for people to use cash accounting. So that was one where I think it really goes to show how important it is to be proactive and not just sit back and wait to see what happens to you, that you really need to be out front trying to adjust these things. In 2017, I think everyone knew following President Trump's election that tax reform was going to be a priority, but we also knew that there were other priorities, including healthcare and infrastructure and other topics. And I think the big question was, what was going to be the order of business? We predicted early on that what we thought would happen is we'd see tax reform pass in either the fourth quarter of 2017 or the first quarter of 2018. That is, in fact, what happened. Now, having said that, I think we were a little surprised by how it happened. The normal order of business for a tax bill, a major overhaul of the entire U.S. economy, would be that you'd have legislation introduced early in the congressional session. So early in 2017, we expected we'd see a bill introduced, and there'd be hearings, and you'd bring in experts, and you'd have discussions about the provisions, and you'd have back and forth. And over the course of a year or 2 years, you'd produce a tax reform bill. And that's in fact what happened in 1986. It took a couple of years for the last comprehensive tax reform to happen. So as Congress took on tax reform in 2017 and really focused on, started the congressional session in 2017, they really focused on healthcare, as you'll all recall, and got wrapped around healthcare and ultimately failed to repeal Obamacare. And it was only at that time that Congress, I think, knowing the Republican Party, knowing that they needed to have a victory going into the 2018 elections, really turned toward tax reform. And in a curious way, the failure of healthcare really set the stage for the success of getting a tax reform bill passed, because it was a must-pass bill at that point for the Republican Party. And whereas I think under a normal circumstance, it might have been hard to hold the Republican caucus together on this bill, I think the context coming out of healthcare and the failure on healthcare really created immense pressure to hold together as a party and to pass tax reform. And as you all know, tax reform did pass on a straight party line vote with no Democrats supporting it, and virtually not the entire Republican caucus. There were Republicans in some of the high wealth states that peeled off because of state and local tax issues, but by and large, they certainly had the votes necessary to pass the bill through Congress. I give you that context because I think it's important to understand how tax reform came together. That really the first bill introduction for tax reform occurred November 3rd. So when you think about it, our expectation was that we'd see legislation introduced maybe January, February, March, and we'd see the bill processed through that time. Instead, we saw a bill introduced right at the start of November, first in the House. A week later, it was introduced in the Senate. By that time, it had already passed through the House committees and was on its way to the House floor. Really, from start to finish, tax reform this go-round took place over about a 1-month period. It was really November into mid-December, a month and a half. That's important to recognize because what would normally be a difficult process to craft a bill that makes sense and holds together, I think was made all the more difficult by the time pressures put on this process. That there was intense pressure to try to get a bill passed in a very short period of time. And so while Congress is never immune from making mistakes, I think in this case there were some bigger mistakes that were made and some very fast decisions that were made, and we're seeing that play out now. And Donna and Justin can talk about some of those items that we saw play out. During tax reform in November and December, as the bill was moving through process, Keiko Isom engaged very aggressively to make sure that we were protecting the interests of ag to the extent we could. We really saw ourselves as being spokespeople along with the American Farm Bureau Federation, the biofuels associations, the ethanol associations, the other commodity groups, really as spokespeople for ag and making sure ag's interests were understood. At Keiko Isom, we also felt a particular obligation because we feel like we understand the tax consequences of this type of legislation much better than virtually anyone else. I think between our client base across the United States, we represent all major commodities, all major ag businesses, and have a critical mass of understanding about how tax reform is going to affect our clients. So we engaged early. We engaged with Chairman Brady, who's chairman of the House Ways and Means Committee, and gave him input. We engaged with staff of Ways and Means Committee. We had a very interesting moment early in the process where the House bill would have actually required payment of self-employment taxes on land rent. We looked at that and said, boy, that's going to really hurt sectors of ag that are renting land, that you're going to have a whole new tax, a tax increase on land rentals. We flew Brad Pollen from our firm to D.C. the next day after that bill came out, had him sit down with Chairman Conaway, the chair of the House Ag Committee, and Brad, along with American Farm Bureau with Pat Wolf, made a very strong pitch about why that was a bad idea. And we were pleased that virtually the next day that provision was stripped back out of the bill. So I think it's a good example of where even with a fast-moving bill, you're able to make some changes to make sure the bill is good, or at least better. The other thing I want to flag for you before we turn to Donna and Justin is the analysis that we did during tax reform. And this was, again, all done very fast because of the compressed time frame. But we had worked with the National Corn Growers Association, the Iowa Corn Growers Association, and the National Pork Producers Council to select model farms that we could test tax reform proposals against. And we really pre-positioned that project months and months in advance. So by the time the bill was introduced in November, we had about 20 farms and hog operations where we had pulled their tax returns for the last 5 years with the consent of those farm owners. And we had built a model so that we could go in and tweak different provisions and say, okay, if you change, 1031 like kind exchange, or if you change section 179, how is it going to affect these farms? And we selected farms that were small, medium, and large in scale and geographically diverse, so we could really get a sense of how tax reform would affect ag. I think we are the only ones nationwide that had the capacity to do that analysis on a very quick turnaround. So during November and December, as the tax reform bill moved through, we analyzed the bills, the House bills and the House bill and the Senate bill on these model farms, and we're able to give feedback to the Corn Growers Association, to the pork producers, about how their members would be affected. And they in turn then use that data and analysis to lobby on these bills and try to improve them. I think our take-home message in both of those examples, with pork and with corn, as we looked at model farms, was that tax reform was by and large a good thing for agriculture. It wasn't something we felt in any instance was something where you really wanted to go out and do cartwheels and get super excited. That the bill made things marginally better for ag businesses on average. We saw that as we ran the numbers that some ag businesses would actually pay more in taxes. So for example, Donna and Justin will talk about C Corps. If you were a C Corp with a low amount of income, paying below paying at a 15% rate, tax reform actually would raise your taxes. So as we looked at the scope of businesses affected, we said on average, most farms and most ag businesses would benefit. They wouldn't benefit necessarily every year. We'd see some tax increases in given years, but on the whole, we thought it was positive. The big flag that we raised and that I'd raise on this call is we recognize, though, that a lot of the benefits to tax reform were temporary. And Donna and Justin will talk about some of those provisions. But some of the really good provisions that make tax reform a net benefit for ag, they are set to expire 5 years out or longer, depending on the provision. And what concerned us as a firm is when we looked at some of the trade-offs that were made in tax reform, a number of useful deductions and tax planning tools were taken out of the tax code, tools that ag had used for decades. They were taken out permanently. So ag gave up some of its flexibility on a permanent basis, and in return got some benefits that are somewhat short-term. And I think as a community, we really are going to have to watch that over the coming years and make sure that we're all pulling together to lobby for extension of the good provisions that Donna and Justin will mention. Otherwise, 5 years out, we could see a tax increase on ag fairly significant. So that's the one flag I think I'd raise for all of you just to be aware of, that as we talk through these tax reform provisions, some of them we could see change 5 years and more now. And so certainly as we advise clients about how to restructure or how to change their business in light of tax reform, we're very mindful of the possibility that some of these provisions will change in the future or could change. And so we help clients to make decisions in light of that. So let me pause there. Donna and Justin, I'll turn it over to you, but certainly at the end of the webinar, if there are questions about tax reform legislation, how it came about, where it's headed from here, certainly happy to chime back in.
Okay, thank you, Brian. And as Brian mentioned, there's a lot of the provisions in the tax bill that do sunset, and we will touch on some of those. But did want to start off with a note for those on the call that might be interested, and I don't have this on a slide anywhere because it just is happening as we speak today. But there is some movement on the biodiesel or renewable diesel blenders tax credit that looks like that credit will get attached to the language with the continuing resolution that they're working on trying to pass today. So the good news is it looks like we're going to get that credit. The bad news is it looks like right now it's only being passed for 2017. So it's just a retroactive fix for the time period that's behind us and not including any provisions for, today and future. There is some work being done to try to get that extended beyond just 2017. So, for 2018, 2019, et cetera, but does not look like that'll be in what gets passed hopefully today or very early tomorrow morning. But there are still a lot of tax credits that expired at the end of 2016 that they are working on getting some resolution and passage on over the coming days, weeks, maybe months. So would encourage everybody to, continue to pay attention and monitor those things. Talk to your folks in DC that can help push some of that through, because just because we don't have them yet doesn't mean that it's not too late. So a little bit of good news coming out of Washington, DC today. What we're going to talk about today is some of the provisions in the tax reform that are the major provisions that we think will impact the ethanol producers. We won't have time to touch on every single provision that's in tax reform, but wanted to focus on the things that are key and have the most broad impact across the spectrum. A couple of comments as we move into that. Tax reform was touted with a goal of simplifying the tax code. I can say with pretty certainty that very little, if anything, got simplified. And certainly there might be one provision in the whole tax reform bill that is, quote, permanent, and that's only permanent until they change it. So while we achieved reform, and I do think there's a lot of good things in the tax reform, we did not achieve simplification, and we don't have permanency around any of the provisions that are in the bill. As Brian mentioned, many of those provisions sunset at the end of 2025. Some of them start to sunset earlier than that, either through some step-down provisions or just flat expiration. So there is some significant complexity involved with that. It was over 1,000 pages, and some of those simplification pieces or some of the complexity is yet to be worked out because it is open to interpretation by the IRS. So the things that, we don't have clarity on, we're still hoping for some clarity. But as with all things related to this kind of a change, that will take time. And unfortunately, the IRS really can't give guidance on how long it will take for them to issue some of those interpretations and guidelines. I think it's safe to say we won't have all of the answers yet in this calendar year. So a year from now, when you're looking at trying to get your tax returns done, there are still very likely to be provisions in the tax reform that we don't have good guidance on yet from the IRS. So it's going to be a multi-year process to work through that. I did mention that there was one piece that might have been simple or simplification in this, and that would be the new corporate tax rate that we'll get into in a little bit. That is the one piece that is quote unquote simple and permanent for now. But again, both of those will change. And I say that as a little bit of a teaser, but don't want anybody to jump to conclusions of, well, that means I should become a C Corp, because there's still a lot of things that we need to talk about and think about in that. So what we're going to do is we're also going to incorporate some of the pieces of the tax reform that will impact individuals. As we wanted to make sure we touched on the business provisions, but also the pieces of it that would impact individual owners of the plants and producers, so that, as you're thinking about, well, how does this impact the ethanol producing company also have some understanding of how it will impact your owners if you're in a pass-through situation. So as we talk about dealing with tax reform, there's kind of a process that we encourage folks to go through so that, when you start to dig into it, that you start off with the right frame of mind, as this is a major change that will impact your business. And they really need a strategy to follow to help you through that process. And so kind of a 5-step process that we are following as we work with clients to work through tax reform, but also as we look at how tax reform impacts our business. And the first of those steps is to organize. So in other words, prepare by understanding what your current situation is, and then make sure you take time to research and obtain knowledge and determine the impact and identify resources and advisors as guides. If you don't start off in an organized fashion, it just goes downhill from there. The second piece of that is to make sure you strategize and identify and analyze those challenges, as well as the opportunities that appear to be the most impactful for you, but then brainstorm around how that could be and create solutions for the provisions in the tax reform bill that look like they might be harmful to you. How do we take the quote negative provisions and turn them into positive provisions? The third step is to reflect and make sure we're assessing the short term, but also the long-term implications of the solutions that we are developing. And to do that from not only what is the tax impact, but what are the other impacts to my business of doing that? And some of those other impacts could be, how does a change, affect your bank covenants, for example, or, some vendor or customer contracts. The piece that gets lost in this a lot is, we get focused on the federal tax reform and we don't stop to think about, how does this impact my state situation? And quite frankly, the states haven't had a chance yet to really dig in and figure out how all of the federal tax reform is going to impact them. And states are just now getting to where they're having to look at, quote, state tax reform so that they can make sure that they're managing their processes in a way that, they've got the right budget and can, still generate the revenue required that might be lost just because of how the federal tax reform changes came into play. The fourth piece of that is to optimize the provisions. So tailor your solutions to match your needs and capitalize on those opportunities and mitigate risk, rather than looking for a kind of canned or cookie cutter approach to adopting some of these provisions, but really stepping back and looking at how do they affect your business specifically. And the fifth piece of that is to then execute by putting your strategy to work and enjoy the successes built around that. Again, a piece that I want to stress in this is, like we've said, many of these provisions are not permanent. So we have to look at what is the short-term impact, what is the long-term impact, and also potentially develop your exit strategy if you make changes. What is my exit strategy 3 years, 4 years, 5 years from now when some of these things start to sunset if we don't have permanency added to them, so that, at the end of that time, you're not in a position where, you might be worse off than if you had done nothing. The next thing I just wanted to touch on real quick is the rate changes, just to kind of give you a feel for what that looks like. At the individual level, we still have 7 brackets. We had 7 brackets before. Today, they range from 10% to 37%. Previously, they ranged from 10% to 39.6%. So you can see the lower end of the brackets stayed fairly close to the same. I mean, they changed a little bit. And the upper end dropped, but it didn't drop as significantly as some people anticipated or thought that it would. But what they did do was they moved that top bracket where it starts from 470,000 up to 600,000. So you have more room for earning capacity before you get into that top bracket than what we had in the past. The capital gains rates or qualified dividend tax rates, those rates did not change at all. So you still have a 15% bracket and a 20% bracket on capital gains. And that's important because a lot of the provisions in the tax reform that apply to ordinary income or business level income do not factor in capital gains. In fact, those can be specifically excluded from some of those limits. So it is important to remember that and keep that in mind. And we'll talk a little bit more about the corporate rates in just a moment, but did want to give you just a little bit of a feel for what some of those individual rates were as we move into the further discussion. So as I said, there are new rates for C corporations. In fact, there's just one rate. It's a flat 21%. So as Brian mentioned, if you had some C corporations organized where you were able to take advantage of lower tax brackets under the old tax regime, you may find that you're paying a little bit more tax in those situations now because of the 21% tax rate. That is effective as of January 1st, 2018. So you can have situations with fiscal year businesses that are trying to apply old tax law and new tax law to the same tax return in certain situations. The corporate AMT tax, alternative minimum tax, was repealed, and so corporations will not have to worry about that going forward. That's not the case for individuals, which Justin will touch on in a little bit. And this is the one provision in the tax reform bill that was written in with permanency. So it is not set to change, but we have permanent in parentheses on this because it's only permanent until they decide that they want to change it. So, it's 21% now, but if in, a year, 5 years, 10 years, they decide that, 21% isn't generating enough revenue, they can raise that tax rate at that point. One thing to keep in mind is there is still double taxation in a C Corp environment. So that's why I say, we really encourage people to, really evaluate, is a C corporation the right environment for you, depending on what your goals and objectives are. Is it time to consider a change? I think the answer to that is yes, it's definitely time to consider it. It may or may not be the time to actually make the change. An in-depth analysis is definitely prudent before you just switch to a conversion, because there's impacts on not only your federal tax rate, but your state income taxes can be different in C Corp environment versus a flow-through or an individual. For some of your members, there also could be some impacts on their ability to participate in some of the farm program payment programs, depending on how they're structured. And then also there can be a change in how you look at some of your management agreements, how you would be able to transfer ownership for your owners, what the estate and succession planning might look like. So a lot of the negativity around C Corps before still remain in place. They just now do have a lower tax rate, but all of the other complications or issues, if you will, surrounding C corporations still remain. In some cases, it makes a lot of sense to revert to a C corporation, but encourage everyone to look at, okay, well, what does that mean, and exactly what part of my business would I want to put into a C corporation? The next provision that I want to talk about is dealing with the changes to depreciation or expensing. And the big one is starting after September 27th, 2017, you are allowed to take 100% bonus depreciation or immediate expensing of new and used qualifying property. And a big key there is used. It used to be anytime we had bonus depreciation, it always had to be new equipment. Well, they have expanded that to also include used equipment, which may not be as big a deal in the ethanol industry, but that is a big deal to some other industries. So I wanted to just make sure we talked about that a little bit. The other piece that we wanted to emphasize here is the definition of acquired is if you had a purchase commitment on, a piece of equipment prior to that September 27th date, it was considered to have been acquired prior to then and would not be eligible for the 100% bonus depreciation. So basically, you have to look at that as if, you can't have made any commitment on that piece of property prior to the September 27th date to have it qualified. So for 2017, we have multiple options on what level of bonus depreciation we want to take on certain assets. We can choose to not take any bonus depreciation, or we could do 50% or 100% on certain assets if they qualify. This does step down after 2022. It starts to decrease by 20% a year. So for 2023, that would be at 80%, and then continuing on at a 20% stair step down until we get to 2026. A piece to remember is historically, a lot of states have not conformed to bonus depreciation, and that's when it was at 50%. I would only imagine that more and more states will decouple from this provision and not allow the 100% bonus depreciation strictly because of the revenue that they will lose by doing that. But again, that's something states haven't really had a chance to come out on yet. The other piece is on the Section 179, which will apply sometimes to ethanol producers, but we don't see it a lot simply because of the annual expenditures, but did want to just make sure everybody was aware that they raised that limit to $1 million and raised the spending limit to $2.5 million before you would start to lose some of your Section 179 eligibility. Again, this is a piece where state conformity is very much undecided and something that we are trying to monitor closely. But like I said, a lot of that just really depends on the states having the time to really dig in and understand how this might impact them. So I would encourage you to make sure that you understand how your state will treat that going forward. One provision that I'm not going to spend a lot of time on, but did want to make sure that everybody was aware of it, because I don't think this will have large impacts to the ethanol producers, but it will have large impacts to your producer owners, is they have eliminated the like-kind exchange deferred gain recognition on property that is not real property. So that will be a change that you'll see, if you exchange a loader for a loader, et cetera, that will get reported differently going forward. Another provision is the business interest expense. And again, just a couple of things to highlight here is this provision was put in place to limit the amount of interest that you are allowed to deduct in relationship to what your adjusted business gross income is. In other words, your EBITDA is another way of looking at that. And they are limiting that to 30%. If you have some interest that gets disallowed, it'll carry forward. And this is one of the provisions that is determined at the entity level as well as the taxpayer level. So you'll have increased reporting that you are going to have to do on your tax return out to your members. And I want to transition now and spend just a little bit of time on the provision that's been getting a lot of attention most recently, and that is the pass-through deduction. And it's been getting a lot of attention in the co-op world, and I'll talk about that in just a second. But what this basically was intended to do was to try to help equalize the tax on pass-through income that individuals will pay and try to make that closer to the 21% C Corp tax rate, to try to make all business income taxed more closely the same. It's a very complicated process to determine what your eligibility for that 20% deduction is. And again, that is determined at the individual taxpayer level. And this is a provision that does sunset at the end of 2025. So again, it's a relatively short-term provision, but can have significant impact and is an area where we see businesses potentially needing to restructure to be able to take the most advantage of that. And one thing to keep in mind is if you've got multiple pass-through entities, you are not allowed to net those against each other in determining what your eligible deduction is. Each entity stands on its own. And as I said, there was some special language put in the bill as it relates to the 20% pass-through deduction for those that do business with cooperatives. This is a provision that has received a lot of attention, and I think all parties involved are committed to putting a fix in place to correct language that was written in a manner inconsistent with the intended outcome. And so thought maybe they had gotten pretty close to having that correction language crafted to put in the continuing resolution bill for today, but don't believe that that language did make it in the continuing resolution for today, but do think it will be in something, either the next continuing resolution or the next legislation that comes up for passage to try to fix an unintended consequence, because right now it really will just create a lot of imbalance in virtually every commodity trading business, all the way from corn that we're used to cranberries, almonds, milk, you name it. And so I do have an example of what that would look like that we'll walk through just real quick. For example, if you were to sell your grain to a co-op, you would get a 20% deduction off your gross proceeds. So if you sold $1 million, you would get a $200,000 deduction. If you only had taxable income of $75,000, you would end up with zero taxable income. Whereas if you had the same situation, but you did not sell your grain to a co-op, you sold it to an ethanol plant that is not a co-op, you would have taxable income of $60,000. Again, very much unintended. I think everyone is committed to fixing it, and something we're continuing to follow very closely. My advice is, if you are in a situation where you are seeing increased competition from a co-op, then it may make sense to look at, do you need to get a co-op structure put in place to be able to deal with that prior to a change coming. However, I would encourage you, if that is the route you take, that we do it in a manner of where you can get out of that co-op fairly easily if you want to at a later time. I went through that pretty quickly, but part of that is because it is something that's getting a lot of attention, but it's also something that we think will get fixed in the relatively near term. So just a couple additional comments on the business and pass-through deduction. Again, it is very complex. It does sunset. There are some exclusions as to who qualifies for that. So not every single business type will qualify for that. Service companies, for the most part, do not. But it is certainly an area where there is a lot of opportunities for tax savings. Excuse me. And one of the areas where I think there's a lot of planning that can be done to put yourself in the situation to be able to take a lot of advantage of that. A couple of other provisions. Cash accounting, Brian talked about this a little bit. And I would say they expanded who can use cash accounting significantly in this tax reform bill. One of the key triggers of that is you have to have less than 25 million of gross receipts. It used to be if you had inventory, you more or less were precluded from using the cash basis of accounting. That is not necessarily the case any longer. So there can be instances where, you know, somebody with $20 million of gross receipts and has inventory can still adopt the cash method of accounting. One note here, though, is the aggregation rules do apply. So if you have multiple businesses with, you know, a lot of the same ownership, you may have to add those together to determine if you're at that 25 million gross receipts limit or not. And then just a quick note on there is some limitations on if business losses and how what level of losses you're allowed to deduct to offset other income versus when you have to carry those forward. And that loss right now limit is at 500 million or 500,000, sorry. Anything over that then will get carried forward to be used in future years. And so at this time, I will turn it over to Justin, and he will talk about some of the provisions as they apply to individuals.
All right, thank you, Donna. Now, as I've met with many of my ethanol plant clients and talked to them, the common theme of what I get is not only what does tax reform mean to me, but also I'm getting calls from our owners and what does this mean for them. And this portion of the presentation is really going to go through a number of changes that affects the owners more directly than it does the ethanol plants as a whole. One piece within tax reform that really changed was the gift and the state tax allowances. What they did is they doubled the lifetime exclusion that's allowed for a person, unfortunately only till 2025, but it did. So what that did was that opened up for all of your owners, it opened up a window to allow those that have good estate plans to relook at it and see if there is more that they can do, but it also allows those that were sitting and waiting to do something estate-wise to say, you know what, if I don't take this extra $6 million that I have in this 8-year window, I'm going to lose it. So there's opportunities to go within that. And really how it affects the ethanol plants themselves is really when you're looking at what the ownership changes are or could be coming within the next up to 8 years and possibly sooner than that. The other piece that came within tax reform is that even with the increased exemption that they allowed for the step up in basis on the estate side. So, I mean, really, not only do you get an additional exclusion, but you also get step up in basis to your heirs, which is just an unbelievable opportunity, one that I'm guessing most people won't cause to happen because you have to die in the process. But as you're looking at that from the ownership level between the gift and estate changes over the next 8 years, what I anticipate is that you're going to see a pretty good amount of movement in your ownership to be able to take advantage of that. Now, when we're looking at the changes to the individuals. We'll look at the next three slides. And in my mind, as I look at it, is the good, the bad, and the indifferent. Like Donna and Brian said, most people are going to be relatively net neutral when it comes to tax on an individual side. And the real reason for it is as we look at these, there are pieces that really help us, there are pieces that don't help us, and there are pieces that don't do a whole lot. When we look at that, the one thing that was touted probably loudest as this was coming through was the standard deduction doubles. In 2017, for a married filing joint person, the standard deduction was $12,700. In 2018, it's $24,000. So that is very nice. That for most people, especially those that aren't allowed or able to itemize, that's a real nice bump. As Donna said earlier, alternative minimum tax did not go away. The House plan tried to get rid of it for individuals. The Senate plan did not, and when they came together, they decided that they were not going to get rid of alternative minimum tax. However, what they did do is that they increased the exemptions, and they increased them by almost 40, or right around 40% to, well, you can see 109,400 marrying filing joint. That, coupled with the fact that we'll get to the bad, that state and local income taxes as well as real estate taxes are limited to $10,000, makes it to where a number of people that were previously in alternative minimum tax situations will probably not be in that situation going forward. However, it is still out there, and there will still be some of those that are hitting a alt-min situation. So you'll have to look out for that. The last piece on this is the child tax credits increased. You see a doubling from 1,000 to 2,000, also allowing non-child dependents to be able to take this credit, and they increased the phase out really quite substantially from $110,000 to $400,000. So that is a benefit for not only the investors but also the employees of your plants, because that's a credit that will be able to offset tax and hopefully put some more cash back in their pockets. Then we get to the bad. The bad are the deductions that were lost. And as we look at that, personal exemptions went away. So part of you says, yay, we got increased standard deductions, and that is a positive. But the personal exemptions really hurts in that process. For 2017, you got a deduction as long as your income was low enough of $4,050 per person. What we're looking at on this is saying that if you had three dependents, let's just say husband, wife, and one child, the increased standard deduction is not as beneficial as it was previously with the lower standard deduction and the exemptions. So that piece does not help most people as we look at it. I spoke of it on the last slide. Non-business, state, local, and property taxes are only allowed as a deduction for itemized deductions up to $10,000. So where you have high income folks, like most of your investors are, that's greatly going to reduce deductions that have previously been taken in the past on that. You also lose all itemized deductions or other miscellaneous itemized deductions that are subject to 2% of AGI. The biggest examples of these, when you look at that, are unreimbursed employee expenses, tax preparation fees, and investment expenses. Those just are no longer deductible, period, at the individual level. The domestic production activity deduction went away largely because of the pass-through deduction that Donna was talking about. What this was at a very high level is for the ethanol that was produced in the United States, the income off of that was allowed a 9% deduction to your owners, or if you're a C Corp, to the company. And the thought process in my mind behind this was that with the 20% pass-through deduction, the DPAD no longer was needed or should be given. So that when we're looking at that, where you say, okay, I get a 20% deduction, that's great. Most companies were already getting a 9% deduction through DPAD. So if we look at it net, we're at best probably an 11% increased deduction coming through that. And the last that we lost is business net operating losses, where previously we were able to carry losses back for 2 years. If you're looking at your owners and their farmers, they were able to carry them back 5 years. Farmers are still able to carry back for 2 years, but nobody else gets to carry back losses anymore. From 2018 going forward, we are at a point in which everything, if you have losses, they have to carry forward. And further on that, not only do the losses have to carry forward, but in any given year, they're limited to 80% of your taxable income. So even if you have a loss equal to your income in that year, you will pay tax because you're only allowed to take 80% of what was carried forward. So those are not great for the individuals as we look forward. The in-between, as I look at this, are the other changes for individuals. The PEAS limitations, which were limitations that came through that limited itemized deductions for high-income people, went away. There is no longer a itemized deduction phase out, which is a good thing. However, also with itemized deductions not starting until after you get over the $24,000 standard deduction, they are a little bit harder to get to in the first place. The 529 educational plans, they expanded. It used to only be for qualified higher education that you could use those funds for, and they expanded that to be able to be used for elementary and high school tuition, including private, homeschool, and a number of others. So they opened that up for more uses, which is nice and helpful to most people. The kiddie tax provisions, where it used to be unearned income was taxed at parents' level or parents' tax rates when it was greater than $2,100. What it now is that the unearned income gets taxed at trust rates. Just kind of put that in perspective, the highest tax rate of 37% for trusts begins at $12,500. So although you're not getting taxed at your parents' rates, what you are getting is you're jumping up the tax rates much, much faster. And any earned income for the children are taxed at the single tax rates. When we look at home equity loans, there is no longer a deduction for interest on for the lines for improvements. However, they did reduce the amount of loan that you are allowed deductible interest, again, only for this 8-year period, to $750,000 of new mortgages. The previous mortgages going on are continued to be allowed up to that $1 million mark that they were previously. On charitable deductions, you used to be limited to 50% of your adjusted gross income, whereas now you are allowed to take deductions up to 60% of your adjusted gross income. If you were paying alimony, you no longer get to deduct alimony, and the person receiving alimony doesn't take that as income for divorces after 2018. If you were divorced prior to that, then it gets to continue the way that it was. And finally, the 3.8% net investment tax still applies. There were some earlier provisions within some of that was trying to get rid of that tax with getting rid of the Affordable Care Act, but that did not happen. So there is still a 3.8% tax on passive income or investment income coming through. So when we talk about this, we talk about how tax reform can shape agriculture, and we continually refer to agriculture in here because agriculture really is the backbone of ethanol plants, of biofuel plants, of all types, because of the inputs primarily, but also because of where they're placed and the communities that we serve within that. And as we look at how it's going to shape, I spoke on it earlier, the gift and estate tax is going to, without a doubt, affect how our farmers are producing and how they're going forward. You're going to see, possibly transfers of farmland and farm businesses from one generation to the next, and the complications that can come with that, just with the changing of the generations and those types of deals. And then also, like Donna said earlier, when we look at the legal and operating structures of the farms and how that applies as far as farm payments and many other things, that can greatly affect how it is. Really, when I look at this and boil it down, what it's saying is that the way that we used to buy may not change, but I'm guessing that it will look different in the future as we go forward. Furthermore, the 199A, which is the 20% pass-through deduction that Donna spoke about, there are going to be impacts if this isn't changed. And even if it is changed, how it's changed is going to cause that. This is one of those things that we absolutely are not sleeping on, nor do we think that you should be seeing how that is, because the way that you purchase grains could be greatly affected. The other piece is that as we're sitting there talking about members, and a number of them are farmers, we also have to take into account that we have a farm bill that's supposed to be coming up in the next couple months, and entity structures and changes to that can greatly affect how you qualify for FSA and those types of pieces. So it's one of those that we cannot jump into conclusions quickly on entity structures or the way the business is run or the way we buy or sell without really taking a holistic view of how all of these impacts come through and affect us going forward. There we go. So to kind of wrap this up, it's a question of what do we do? How do we respond? Because I think we would all agree that the worst thing that you can do is sit back and be reactive. We absolutely need to be proactive in this process to make ourselves, to allow ourselves to be in the best position to take advantages of what came through with tax reform. We absolutely have to be proactive in this and start moving forward today. Like we said, where there were the opportunities to trade in the past, we need to take advantage of those because the trade rules have changed. Wherever we have the ability to defer income, we should do today. Just looking at the tax structure that we have, the rates alone decreasing make this incredibly attractive. Where we can, like Donna said, where we can take more depreciation, where it makes sense for your owners, we should. If you have income on contracts that you can defer, you should defer those types of deals that you really need to get with your advisors if you have not already, to be able to understand what impacts you have and how can you shape that going forward. Another piece is with the uncertainty with how the provisions are going to go through. Most of us like to button up last year, file our tax returns, and move on to the next year. That may not be the best thing to do in the current year. With the uncertainty of what we have going forward on how these provisions are going to play out, on the technical corrections that are going to come through, you may be in the best position to extend your return for 2017, so you have a better picture of what is 2018's rules, so that you can make sure that you have yourself in the position for success. And finally, like we discussed earlier, we have net operating loss pieces that if you have the ability, again, to defer income, to drive losses, it allows not only you, if you're a C Corp, but also your members to take those losses, and if it can drive back, you can recoup some of the tax that was paid in the prior years. So it's one of those that going forward will not come back again. So with that, the question is how am I proactive? How can I get a better handle on what's going on and what my situation is? Here at KCOISM, what we offer is a tax reform assessment. And within that, there's really three pieces that come into play. There's a rapid assessment that goes within about 2 weeks, where we look at your prior year's tax return, identify the key provisions off of that really will affect you, looking at about 15 main provisions that come through, so that you understand what areas of your business you are looking at being impacted in. The next thing we do is we take the information, we run it through a tax impact analysis, where we really look at high-level specific areas of what the law means to your business and how it's going to affect you. And from that analysis, we sit down with you and we go through that and we talk about, not only how you're going to be affected or ways that you could impact change within that, but also, looking forward, what areas do we see where there are weaknesses or abilities that we could really proactively take on what's going forward. So with that, to get with us, it's quite easy to visit our KCO website, or reach out to any of us, Donna, Brian, or myself, and we would love to talk with you about how we could help you to shape your future. And with that, I think we're ready for the question portion.
Hey, thank you very much, Justin, and thanks to Brian and to Donna as well. We do have some questions in the queue, so I want to go ahead and get started on those now. I do want to remind our listeners, if you do have a question for our speakers, go ahead and please type it into the panel on the right-hand side of your screen, and we'll try to get through those in the next 15 or 20 minutes. So for starters, Donna and Brian, at the beginning, you all had mentioned the budget resolution going through today, and we've got a question about what the status of the Hatch tax extenders bill is, as it does not seem to portend well for a tax extenders bill if they are placing certain provisions on the budget bill. Of course, I think the person who's asking this question is referring to Senate Bill 2256, and for biodiesel specifically, Section 307, which included a multi-year extension for the $1 per gallon biodiesel tax credit, retroactive through last year and up through this year. Is what's being voted on today another temporary solution? And if so, does that mean, as far as the budget goes, does that mean there'll be another opportunity here in the next month or two to get a forward-looking biodiesel tax credit in another budget bill?
Well, this is Brian Keel, and I'll comment on that. So first, it appears that the budget bill may not get a vote today. I was just seeing online that there may be a delay in the Senate by a day. But putting that aside, so Senator Hatch introduced an extenders bill. What's happened now is there's been a negotiation over which of those provisions should end up in this budget package. So in essence, the odds of Senator Hatch's extenders bill moving as a standalone bill are extremely remote. I'd say practically zero. That what we're likely to see are the extenders that have political support and a consensus to move as part of this package will be in this package. Now, that doesn't mean you won't see another bite at the apple or additional efforts to try to move other provisions in some other way or some other forum, but I wouldn't look toward Hatch's tax extenders bill as a vehicle.
I would agree with what Brian said. I wouldn't automatically give up on a multi-year extension on the biodiesel tax credit in some future provision. I think most of what we're seeing is there is support for it. It's just finding the right, quote unquote, must-pass legislation that they can attach that to get it there.
Okay, thank you both for that. We've got another question, and hopefully one of you will be able to address it. Donna, this came up during your presentation. The question is simply, did they keep the tax credit for chip equipment?
I would have to check on that to make sure. I think the answer is yes, but I don't know that for sure. But I can certainly find that out and get the person that asked the question the answer. Ron, if you can get me their information, so we make sure we get them the right answer.
Okay, sure thing. Another question. What types of ethanol producers will benefit most by tax reform, and conversely, what types of ethanol producers will be most adversely affected by this tax reform?
I think it sounds like a cop-out, but the answer is really it depends, because I think there's certain pieces of the tax bill that, impact C corporations, if you're a C corporation, more favorably than flow-throughs, but there's pieces on the flow-throughs that I think can be very beneficial. I don't think there is anything that is size dependent as it relates to the ethanol producers. So, from that standpoint, I think there's a lot of cases where what we might see is a combination of a flow-through and a C corporation structure put in place to make sure you maximize all opportunities. But I don't think there is a situation where, you're either a guaranteed winner or a guaranteed loser in this.
Well, and I would agree with Donna, and I would probably be even more vague. What type of ethanol plant is going to be a winner versus a loser really is a question of, is the ethanol plant going to be proactive in understanding its options? Because that's really where you're going to define and identify the winners and losers within tax reform as this goes. Because like Donna said, there is a number of different ways where you can look at how you can structure your entity, how your ownership feels, and those types of deals. Because the bottom line of all of it is at the end of the day, we make our money by producing ethanol, not by whether or not we can save taxes. So if you're going to do something that's detrimental to the core business values, you're going to be a loser within there. But for the purposes of this, you have to identify what areas and what situations you can really capitalize on to be able to identify where you're going to end up without interrupting what you do, and that's make ethanol.
Got it. Thank you. Another question. So Justin mentioned the Farm Bill coming up. What might happen in the Farm Bill, for instance, that would affect this new tax code? Have you got an example that you can share with us that, you said don't make any rush to judgments, but if this farm bill comes out, there may be some complications. Can you provide an example of how what might be in the farm bill would affect what we're seeing in the new tax code?
The biggest thing that I look at within that is with any farmers that are coming through, the entity structure is pretty paramount as far as it goes with your FSA payments and eligibility. So it may make sense within tax reform to turn into an LLC or to restructure your entity to being an LLC, but you only get one allowance as a limited liability company versus if you're a general partnership with a number of LLCs under it. So that's where, when we're sitting there looking at it and talking about this, saying that it's really all encompassing with any decision that you have to make, to where you can't just look at any of it in a vacuum and say, okay, because of tax reform, this is what I'm going to do, but then I'm hindering myself on the backside because I no longer am FSA eligible or have the allowances that I did previously. So really, when I'm talking about that, as far as the farm bill coming in, those are some of the pieces on my side that I really think about when we're looking at any of these plans or structures.
All right. Another question. The attendee asks, our employees are confused about the standard deduction and home mortgage interest, real estate taxes, state taxes, and medical costs. Did I hear you say you can still deduct these with limits? Would most be better off to just claim the standard deduction? Is it either or?
It is either or, and really it works the same way that it did before, of that your standard deduction is $24,000. So if your mortgage interest, your state taxes up to $10,000, your medical and your charitable contributions will just say come up to $20,000, you're going to take the standard deduction. If all of those expenses come up to $26,000, you're going to itemize and you're going to have $26,000 of deduction. So that's really where it's looking at, as far as that is that barrier, that threshold moved up to the 24,000 mark. If your itemized expenses allow for more than that 24,000, then you're going to itemize and you're going to take those deductions.
I would say I think the biggest change there is there did not used to be a specific limitation on that state tax line, so which is comprised of your real estate taxes, your state income taxes, personal property taxes. That did not used to have a specific limit to it that they now put a limit in place on. So that, I think, is leading to a lot of the confusion around, should I itemize or should I take the standard deduction? And there may be people that in the past, because of state income taxes itemized, that with that being limited, they may now use the standard deduction because it'll be most beneficial to them.
All right. We've got another question from an attendee. Did the MLP Parity Act, or the Master Limited Partnership Parity Act, qualifying renewable energy for MLP treatment, get into the budget as it was to be inserted into the Hatch tax extenders bill, which sounds like it is no longer moving independently? Maybe that's awfully new, but is any one of you three able to address that?
I'll take a pass on it.
Thanks, Brian.
Go ahead, Donna.
Well, I was just going to say, is the question, is that in essence, the continuing resolution bill? Is that the question?
Let me see here. Yeah, it doesn't say. It just says get into the budget. Did it get into the budget? Right.
Because there was a budget bill passed yesterday, I believe, but I've not been able to get the details of it to know if that's in there. So honestly, I don't know the answer if it made it in or not.
Okay. Certainly, the person who asked that question can reach out to the
Yes.
experts at KACO, ISOM, and get answers. And so, you all had talked about some of these provisions being expiring, and maybe be some work down the road to extend them in future years. What would it take to do that? What kind of feat would it take to get Congress? Would it be sort of like what we see with some of the renewable energy credits, having to extend them year after year? Is that what we'd be looking at in the future for some of these expiring provisions?
So this is Brian Keel, and yes to a degree. So some of the bigger changes to the tax code are set to expire, and those aren't so much like rifle shot provisions like you might see, a particular tax credit expiring. It's a bigger change that was put in place, but then for budgetary reasons, Congress set it up to expire. So I think one thing that frustrated a lot of people in ag is that the C Corp rates were put in place as a permanent change. At the time, the argument from the administration was, well, C Corps need they need to have the certainty that goes with permanence so that they can plan investment decisions. And I think for most of us in ag, where you don't have as many C Corps, you have a lot of pass-through entities, that rang kind of hollow, because you say, well, our pass-through entities need to plan as well, and yet the benefits to the pass-through entities do sunset. So those are not so much like extenders. That's going to be a big fight when it happens. I think one of the big concerns we have is you look at the spending bill that Congress is looking at right now. They're looking at adding, $500 billion more to the deficit on top of the $1.5 trillion in the deficit that the tax bill put forward. At some point, that check becomes due, right? You can't deficit spend forever, and I think there's a lot of concern about how much we've been deficit spending, and I think that's part of the volatility you're seeing in the stock market over the last week. When it comes time to extend these provisions, it's a lot easier to hold on to something that's permanent, like the C Corp rate, than it is to actively pass a bill that would extend the pass-through provisions. So I think that's one of the big concerns is even though there's going to be a lot of political force behind extending them, you're going to be also facing a budget crisis. And so that's a very real concern for us. In terms of what people can do, couple things. I mean, one is certainly work with your associations. They do a very good job of advocating on issues specific to your industry. If there are particular issues that affect you differently than others in your industry, reach out to us or others who maintain lobby offices and talk to us about the issue that you're looking at and where you might want to see it tweaked. That's true both for changes on Capitol Hill and also, if there's a particular IRS rule that we need to adjust to make sure that you fit squarely within the way a bill's drafted. Once again, KACO tries not to be reactive. We try to be proactive. So if our clients have particular needs, we try to go out and make sure those needs are met. So I'd say reach out to your association, reach out to us if it's a specific issue you want help or guidance on.
Thank you, Brian. I think it's appropriate to end on this last question. It seems as if this would be a good question to wrap up on. What do you think the long-term effects of this tax reform will be on both the U.S. economy in general and the U.S. ethanol industry specifically?
Boy, that's a big one, and probably a number of us could weigh in on it. I think this is Brian, and I'll just give my own opinion. When you look at the economic effect on the U.S. economy, I mean, it's clear that it is driving some investment into the U.S. Some of that's the repatriation of dollars. Some of that's freeing up dollars for C Corps or pass-through entities where they see a tax benefit. So, predictably, you'll see an economic stimulus. My own belief is it's not going to come anywhere close to offsetting the deficit side of the equation, that you won't generate enough revenue to offset the deficit impact of this bill. And again, I think that's part of what's roiling the stock market. I think there's an argument that the economy was already pretty heated when this bill was passed, and it may be a little bit too much for the system. And I think that's something we're going to watch over the coming months. In terms of the impact on the ethanol industry, I think Justin and Donna could comment on specific provisions there. I think one thing that people should be watching with respect to ethanol impacts generally would be also the trade context. I think we tend to get focused on Farm Bill, we tend to get focused on renewable fuels credits, et cetera. When you look at what's happening with international trade, with whether NAFTA is going to be renewed, those are very big impacts on these industries. And again, as I mentioned, that's something we're tracking, but I would encourage people to keep an eye on that and reach out to us if that's an issue of concern. Donna and Justin, how would you wrap up?
Well, I think what's difficult with that is where you say, what is the long-term impacts? And the real question that's in my mind is, what is long-term as it pertains to the tax reform bill? And that's where there's so much that is so difficult within there, of saying, not only do I need to do something to take advantage of what I can, but I also have to be in a position to where if I need to, I can wrap it up quickly to where I'm not putting my company at a detriment going forward. So, I mean, as far as from the ethanol perspective, as an industry, I think that there are definitely some provisions that can be huge that are still out there. The pass-through deduction, especially as it appears to co-ops, I think, depending how long that's allowed to go, if it's allowed to go, could greatly impact that, depending on how you source your grains or other feedstock that go into your plant. The other thing is that as that goes in further, it's really a question of, like Brian said, how is your ethanol being sold? We know just from the industry itself that, the inventories are a piece. And if, like Brian said, on the international side, if there's anything that hiccups what's allowed to be exported, then we're going to see huge swings in prices that's going to hurt. That's not really tax reform related as but I mean, you guys all know that there are so many risks that affect a ethanol plant more so than just tax reform. But that's probably the biggest provision in the tax reform that I think could have long-term effects.
And I would say just quickly, I think short-term and mid-term, there's a lot of positive in there for the industry. Long-term will be dependent upon how we apply and implement this in the short term to make sure we've got the long-term strategy there that would make sense. Because in my perspective, there's nothing in the bill that is long-term, because there's just almost every provision has some level of sunset to it. So.
All right. Well, thank you, Brian, Donna, and Justin. And remember, for those of you on the broadcast, if questions arise as you work to plan for these changes, reach out to the experts at KACO ISOM. At this time, I'd like to once again thank our panelists, and a special thank you to our sponsor, KACO ISOM. Right now, we have an exclusive discount for those of you registered for this webinar. You can receive $50 off the early bird rate when you sign up for a full conference registration to the International Fuel Ethanol Workshop and Expo, June 11th through June 13th in Omaha, Nebraska. Give us a call at 866-746-8385 and mention the discount code FEW Webinar. This exclusive discount expires May 1st. Finally, I'd like to tell you about some upcoming BBI International events that we have scheduled. Join us March 1st for a free webinar on growing E15 adoption with Growth Energy. April 16th, we have the Biomass Carbonization and Torrefaction Summit held in Atlanta, Georgia. And April 16th through 18th, we've got the International Biomass Conference and Expo in Atlanta as well. And of course, June 11th through June 13th, we'd love to have you join us in Omaha for the International Fuel Ethanol Workshop and Expo, which will be co-located again with the Advanced Biofuels Conference. We look forward to seeing you there. And we'd like to thank all of our attendees once again for joining us today. And a special thank you to our speakers at Keiko ISOM for sponsoring this event. Have a wonderful February, everybody. Our broadcast is now concluding. Thank you.